everybody, welcome to July's newsletter. Today I want to talk to you about long-term money versus short-term money. So the difference between long-term money and short-term money is you want to take your long-term money, which is usually for retirement, and you want to put it into a long-term investment, like a rental property. Short-term money, like maybe you saved $20,000, $30,000 on the side, or you have hard money that you're putting together with your money to do a quick flip, that's a short-term investment and short-term money. Very high risk. Today it's important that we discuss that you not put your long-term money into short-term investments that have higher risk and could put your retirement funds in jeopardy. So we want to figure out ways to protect our long-term money by making our rental properties more efficient. The way that we're going to make our rental properties more efficient is first you have to be self-aware and understand your position in your rental property. What do I mean by that? Some of you have loans on your property, and some of those loans might be at a 9% interest rate, and there are banks now that will give you a refinance on those loans, especially since the value of those properties have gone up and the loan to value is really good. And you might get more like a 6.5% or 7% interest rate, which improves it about a 3%. If we do that in combination with increasing the rent for inflation, you're now going to cash flow more and get a better return on your long-term money while keeping it protected. Now, why is your money protected in a rental property versus, let's say, in the stock market or in a flip property? A flip property is usually in a higher price range, and if the market goes down, you'll lose that profit margin and you'll have a hard time exiting, and you also won't be able to rent that property for the same amount that you'll need to get a return on your money. Also, the stock market, if you invest $100,000 today, you get paid a percentage on that money. If the value of that stock comes down, your percentage on that lower value also decreases. If you have a rental property and you bought it for $100,000 and it rents for $1,000, no matter what happens to the value of that house, it doesn't matter in the time that you're renting it because you keep that $1,000. So essentially you're protecting yourself from your cash flow and you're protecting yourself from the value because you choose when you want to sell that house, and you're likely going to choose to sell it when it's in a positive state instead of in a depressed state. So these are some important ways to look at your investment. I think it's important to keep long-term assets and reposition them in order to grow your wealth. The last thing I want to talk about is we've done 2 other newsletter videos, and I want to get some feedback on things that you as the investor are looking to hear from me in the way of maybe you want market info, maybe you want more specific info about maintenance on your property or management on your property, or maybe you have some questions. Go ahead and respond to this email and we'll reply, or we'll do another video or a series of videos to answer all your questions. If you guys need anything, our entire team is always here to help you, and I also am happy to answer any emails from you on your properties that you currently own with us or on some future properties that you guys would like to also purchase from us.